bottom line is that for 20 years, we suppressed interest rates. By suppressing interest rates, we created this perception or this illusion of prosperity. And so if you have suppressed interest rates, why then you have to step on the price of gold, because by stepping on the price of gold, it signals strength in the underlying currency, strength in the bond market, as illusionary as it would be. Because if you are going to have nothing in the way of interest rates, of zero on the federal funds rate for all of those years, then there's no opportunity cost in buying gold and silver. And that's one of the reasons why they would step on it, to promote an illusion of strength in the bond market and in the dollar market. And, what it really is it's a barometer on the health of the system. The higher the price of gold and silver goes, it shows the flaws and the fragility in the underlying markets. I don't think that's really been priced in as much into the gold market because, again, fine line between conspiracy and reality. But when you take a look at what has happened, in fact, let me just read to you exactly, if I have it here, what has happened with the price of gold. Price of gold and silver are managed by the commercial banks. And I mean, that's the truth of it. The commercial banks are the ones that control the price of gold. It's controlled on COMEX. That's ending because the big money across the globe understands this. The central banks have been using the Western suppression against us for a very long time. They know this. In fact, I've said before, the head of the Shanghai Gold Exchange says, when the real price of gold, when China is allowed to speak at the table, the real price of gold will be observed. They talk about the new grain exchange that they just developed, the BRICS grain exchange, and they say, we produce more grain and soft commodities than the West does, yet we have no control over its price. It's all controlled on COMEX. That will change with the new BRICS grain exchange. They understand that we have been controlling the paper price of all of these commodities for a very long time. But I'll give you an example of what just happened. I see if I can pull it up here. I was just reading it. There's a tremendous amount of short covering that has happened on the market. And I just want to find it. I'm sorry I don't have it at my fingertips. Okay, here it is. So the Commitment of Traders report just showed that the managed money crowd for gold and silver futures have been fleeced. That was the gist of it. And the gold longs sold 4.488 billion in long futures, silver longs 1.7 billion in futures. These are the managed monies. And so leverage is a double-edged sword. So look, here's the deal. There's the commercial banks. What they do is they suck in the speculation. They let the price run, and they will suck in all the managed money, and they'll absorb all of that buying pressure. But they have enough money where they are able to sell into a rising market. Very dangerous thing to do. Most people, when they short, think AMC and GameStop, they short a falling market and pile on, right? It's like, when you played tackle football with your buddies in elementary school, everyone would jump on, pile on, hog pile. Well, that's what normal people do when they sell short. The commercial banks have enough money and really unlimited amounts, and they do it in a collusive manner where they are able to absorb all of the buying pressure, let the price rise, and then start to sell and overwhelm the buying pressure and drive the price down. As they drive the price down, all of those longs and all of the options expire worthless, and you get all of the managed money that end up jumping ship. These hedge funds do not have a high pain tolerance. So as the price starts to go against them, they jump ship. When the longs sell their longs and cover their shorts, in other words, they are getting out of their short position, they're selling their longs. The opposite side is the commercial banks. They're taking those longs and they're going long. So in other words, one of these days, and I believe we're getting much, 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 much closer to it, the commercial banks, and maybe this is the time, who knows, will flip-flop and they won't short a rising market. They will push all of the managed money to the other side of the table, as right now they're in the process of moving to that side of the table, and they won't let the price, they will not let the managed money back into it. In other words, managed money will go short. Right now, when the managed money sells their longs and buys shorts, the commercials are taking the other side, and that's what has happened.
Gold and silver markets are often viewed through the lens of supply and demand fundamentals. But there's a shadowy side that plays a crucial role: market manipulation. The price of gold and silver is not just influenced by natural market forces, but is significantly managed by major commercial banks, particularly on platforms like COMEX. This manipulation has been a long-standing open secret in the financial world. As frustrating as it may be for the average investor, understanding this manipulation is key to grasping the true value and potential of these precious metals. It's not a conspiracy theory, it's a reality acknowledged even by insiders. The head of the Shanghai Gold Exchange once remarked that the true price of gold would only be realized when China is allowed to fully participate in price-setting mechanisms. This statement reflects the broader understanding that the price of gold, as observed today, does not fully account for its true market value due to Western financial manipulation. The introduction of initiatives like the BRICS Grain Exchange aims to shift the control of commodity pricing away from Western institutions, signaling a broader move to decentralize financial power. The commitment of traders, NANAR COT, reports often reveal startling trends. Recently, these reports indicated that managed money, which includes hedge funds and other speculators, had been significantly fleeced in the gold and silver futures markets. They were caught on the wrong side of the trade, selling off $4.48 billion in gold futures and $1.7 billion in silver futures. This is part of a broader pattern where commercial banks, with their vast financial resources, allow prices to rise and attract speculative buying, only to then short the market and drive prices down, causing speculative positions to lose value. This strategy is akin to a high-stakes poker game where the commercial banks hold all the aces. They have the capital to sustain losses temporarily while they short a rising market, a risky move for most but feasible for these financial giants due to their deep pockets and collusive strategies. This practice is not unlike the infamous short squeezes in stocks like GameStop and AMC, but on a much larger and more systematic scale. The banks essentially pile on the market, creating downward pressure that forces managed money to liquidate their positions, often at a loss. The silver short, a deep dive into market control. The situation is even more pronounced in the silver market, where 8 commercial banks hold the largest concentrated short position in any commodity ever traded on COMEX. This raises a critical question. Why would these banks maintain such massive short positions, especially in a market as small as silver? One plausible explanation is that these banks are working in conjunction with governmental or industrial interests to keep silver prices artificially low. Silver is a crucial component in many industrial applications, including electronics and military equipment. Keeping its price low benefits these sectors by reducing production costs. However, this manipulation has not gone unnoticed. Savvy investors and nations are using this suppressed price environment to their advantage. Countries like China and India are taking advantage of the suppressed prices to accumulate vast amounts of silver. They are methodically draining the market, leveraging the artificially low prices to stockpile this essential metal. This massive acquisition is not just for monetary purposes. It's also about securing a resource critical for technology and industry. The patience and long-term vision displayed by these countries contrast sharply with the short-term focus often seen in Western markets. The suppression of gold and silver prices is a risky game, fraught with potential pitfalls for those trying to control the market. While commercial banks have historically been able to manage these risks due to their vast resources, the growing global demand for physical metal is making this strategy increasingly untenable. As countries like China and India continue to drain Western vaults, the physical market's constraints become more apparent. This depletion is a ticking time bomb, waiting to explode when the realization dawns that the physical metal simply isn't there to cover all the paper claims. For investors, this creates both risks and opportunities. The risk lies in the potential for continued manipulation, which can distort market signals and lead to unexpected losses. However, the opportunity lies in the eventual market correction, which could offer substantial gains. Investors who position themselves correctly, understanding that the current prices are artificially low, could reap significant rewards when the market finally corrects itself.
For a very long time, it was done for something called Gibson's paradox. Gibson's paradox is the inverse relationship, in essence, between real interest rates and the price of gold. And if you are going to maintain an environment of very low interest rates, see, it's the interest rates, it's not the gold manipulation, Danny, that matters. It's the interest rate manipulation that we've seen for 20 years, where suppressed interest rates have created an illusion of prosperity, where your home prices, your stock prices, your 401k, everything went higher in value. And that's another big problem, by the way, for the commercial real estate industry, where all these buildings were purchased at the lowest interest rates in American history. And now that rates are moving higher, on the long end, what does that mean for these values? And that's another big issue. But the bottom line is that for 20 years, we suppressed interest rates. By suppressing interest rates, we created this perception or this illusion of prosperity. And so if you have suppressed interest rates, why then you have to step on the price of gold, because by stepping on the price of gold, it signals strength in the underlying currency, strength in the bond market, as illusionary as it would be. Because if you are going to have nothing in the way of interest rates, of zero on the federal funds rate for all of those years, then there's no opportunity cost in buying gold and silver. And that's one of the reasons why they would step on it, to promote an illusion of strength in the bond market and in the dollar market. And what it really is it's a barometer on the health of the system. The higher the price of gold and silver goes, it shows the flaws and the fragility in the underlying markets. And I think that's kind of the problem, is that these commercial banks have done this for so long, created such massive short positions, that they're trying to slowly, I think, extricate themselves from these very, very large short positions, some of the largest in the history of the COMEX market. So what this chart is here, this is the COMEX market. This is a presentation I gave at Rick Rule's conference recently. And these are all the commodities that you see. These are commodities traded down here on the COMEX. This is the red line are the top 4 banks, big commercial banks, and the green is the top 8 combined. This is the short position in silver, the largest concentrated short position in any commodity ever traded on the COMEX market by 8 banks. You tell me, what the hell is that for? Why would, look at oil over here. Corn, sugar, soybeans, cotton. Why would you have 8 banks that represent the largest concentrated short position in the history of the COMEX? Look at the top 4 shorts: silver, platinum, gold, palladium.
Interesting.
Why are they shorting the price of all of these metals? And that is the question that people need to understand. And so let's take a look at the next chart. This is how the rest of the world is using this against us. This is the amount of silver held in the LBMA. The rest of the world says, fine, you guys, now that we're wealthy enough and industrialized enough and coordinated enough, you guys want to short the hell out of the paper price? Go ahead. This is what we're going to do. We're going to stand for delivery and drain your exchanges. That's exactly what they are doing.
Yeah, it's next to nil now.
Suppression of the Western paper market against us. They know what we're doing, slowly draining the vaults.
At some point, the fundamentals will override these manipulative tactics. The continued depletion of physical inventories at major exchanges, like the LBMA and COMEX, indicates a growing divergence between the paper prices and the actual physical availability of these metals. When the supply of physical gold and silver becomes too scarce to meet demand, the market will be forced to recognize their true value. This recognition could come swiftly, triggering a massive revaluation of both metals. The idea of Gibson's paradox is relevant here, which posits an inverse relationship between real interest rates and the price of gold. For years, artificially low interest rates have created an illusion of economic prosperity, inflating asset bubbles in real estate and stock markets. To maintain this illusion, the price of gold has been suppressed to prevent it from signaling the true state of economic fragility. However, as real interest rates begin to rise, possibly due to inflationary pressures or changes in monetary policy, the cost of maintaining these short positions will become unsustainable. One of the most anticipated events in the precious metals market is the potential big flip by the commercial banks. Historically, these banks have maintained large short positions to keep prices in check. However, there is speculation that they might eventually switch sides, covering their shorts and going long. This shift could happen suddenly, especially if they anticipate a significant increase in demand for physical delivery that they can no longer meet. When this flip occurs, it could trigger a dramatic rise in prices, as the commercial banks would be buying back their short positions while simultaneously going long, pushing prices upward. This scenario would be exacerbated if managed money, usually quick to follow trends, finds itself on the wrong side of the trade once again. As these funds try to cover their short positions or re-enter long positions, the demand surge could be massive. This shift could lead to a situation where the supply of available gold and silver simply cannot meet the sudden spike in demand, causing prices to skyrocket. Central banks have been pivotal in the manipulation and suppression of gold and silver prices. Their actions are not just about managing monetary policy, but also about maintaining control over their national currencies. A higher gold price often signals a weaker fiat currency, undermining confidence in the financial system. By keeping gold prices suppressed, central banks attempt to project strength and stability, even when economic fundamentals suggest otherwise. Moreover, the geopolitical landscape plays a significant role in shaping the dynamics of precious metals markets. The ongoing trade tensions, sanctions, and geopolitical conflicts have increased the demand for safe haven assets like gold and silver. For instance, the US dollar's weaponization through sanctions has pushed countries like Russia and China to diversify their reserves away from dollars, leading them to accumulate more gold. This geopolitical diversification away from the dollar is a critical factor that could drive up gold prices as global reserve compositions shift. As we look to the future, the global financial system appears to be on the brink of significant changes. The increasing adoption of digital currencies, the potential revaluation of gold, and the shift in global economic power dynamics all point towards a new financial paradigm. In this evolving landscape, gold and silver are likely to play an increasingly important role as stores of value and as anchors of stability. Investors should consider the long-term potential of these metals not just as a hedge against inflation, but as a core component of a diversified investment portfolio. The manipulation and suppression we see today are unlikely to last forever. As market fundamentals reassert themselves, the true value of gold and silver will likely be revealed, offering substantial returns to those who have patiently held these assets. In conclusion, the manipulation of gold and silver prices by commercial banks and the broader financial system is a reality that savvy investors must navigate. While frustrating, understanding this manipulation provides a strategic advantage. As the global financial system faces increasing strains, the true value of these precious metals will become apparent. The key is patience and a long-term perspective. Gold and silver are not just commodities. They are stores of value with millennia of history behind them. As we move closer to a potential financial reset, these metals will likely prove to be invaluable assets. Thank you for joining us in this deep dive into the complexities of the gold and silver markets. Stay tuned for more insights, and remember, in the high-stakes game of financial markets, knowledge is your greatest asset. Stay informed, stay strategic, and prepare for the opportunities that lie ahead. Whether you are a seasoned investor or just starting, the future of gold and silver offers a fascinating journey filled with potential rewards and challenges. Let's navigate this evolving landscape together and secure a prosperous future.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.